Welcome back to Recap Mac. We're going to continue to learn about macroeconomics and monetary policy. Okay, so now we're going to dive into new types of monetary policy tools that we have not discussed yet in the previous videos. This is still considered traditional types of monetary policy tools. They were not created after 2007. Okay, but maybe as I'm going to point out, they have different goals. They're used for different purposes, despite still having an impact on economic activity. So the hope is that you're going to be able to connect that, given that the Federal Reserve changed those policies of reserve requirements, and the one I'm going to talk about next, discount rate, you're going to be able to predict what can happen in terms of economic activity and connect with changes in GDP, changes in unemployment, changes in inflation. Okay, so the first one we're going to mention after the Federal open market operations is reserve requirements. So reserve requirements here, like we talked about in the money and banking chapter, is about how much money bank requires to keep in their vaults to meet with with responsibilities from their depositors on a daily basis. Okay, so the idea here is that if the central bank increase the amount of reserve requirements, right, that will cause banks to have less money available to make loans, right, which then would lead banks to lower the amount of loans being given out, which lowers aggregate demand for the economy. Okay, so for example, in early 2015, the Federal Reserve required banks to hold reserves equal to 0% in the first $14.5 million in deposits, 3% up to $103.6 million, and 10% and about above that. Okay, so you can see here that the Fed also has an idea about how the size of banks, and it's really hard for smaller banks to control that. So you can see that the banks are heterogeneous. The Federal Reserve does control that, but they still use this idea of reserve requirements to be able to limit banks in terms of the amount of loans they give, and as you can see, control how risky banks are getting. Okay, so the idea here, more than controlling the interest rates in the economy, the federal funds rate, which that one is more done to the Federal open market operations, is here to control the level of risk of banks by requiring them to keep more or less reserves. Okay, if they keep more reserves, less economic activity. If they keep less reserves, more economic activity through the money multiplier. Okay, the second policy we can talk about is the discount rate. So that's the idea that this is the interest rate, not that banks charge one another for overnight loans, but the Federal Reserve charge banks if they come ask for help for loans. Okay, so if they need money and they come get a loan from the Fed, discount rate is the interest rates that they pay. Okay, so obviously here, if you're changing the cost of failing and going to ask for help, then that's going to change the behavior of banks, right? If you make more expensive for them to have to get help in case they need it, the idea is that they're going to be more risk averse. They're going to maybe give less loans out, and they're going to be more careful about the loans that they're giving out, to who is getting the loans, right? But if you lower the discount rate, you're saying, hey, it's cheaper. If you need money, it's cheaper to get money from us now. Then the idea is that you're incentivizing banks to be a little bit more riskier because the opportunity cost of failing is not that high. Okay, so that's the idea here. The idea of being the lender of last resort does have an impact on the business model of banks, okay, and how they're giving out loans. Okay, so let's connect that all with economic activity. But first, I think it's really important to focus on understanding everything that we've seen so far. So let's make sure that you follow this policy analysis so far, and let's imagine that the central bank has raised the reserve requirements from 10 to 20%. Okay. So let's see if you know how a bank could react in this case. Let's say you work for, you're the CEO of Southern Bank and you have to make this decision that now you don't have enough reserves because you don't hold 20%, you're holding 10%. So what do you do to be able to meet those requirements? Where do banks go to be able to get help? Right? Do they go to the central bank? Well, we know that unless they're in deep trouble, that's probably going to be their last option. So it's not D, right? They buy bonds to increase reserves. We know that bonds and reserves are not the same thing, so that can't be B either, right? But they increase advertising to get more depositors. Maybe that's a long-term goal, but you know that's really hard to get, right? And also it depends on how depositors are feeling about the economy. If the economy is going through a recession, right, then maybe now it's a lot harder to get depositors, right? So now we're going to start evaluating, Eddie, why would they lower reserve requirements during a recession? Yes, that's exactly the type of questions I want you to ask. I want you to understand why a policy is being implemented and be able to evaluate whether it makes sense or not, and what's the implications that will have in our society. Okay, so in this case, we know that as we discussed before, when banks are needing short-term loans, they go ask one another, right? Instead of going ask your boss, you much rather go ask your coworker, because maybe that your boss is going to have the perception they don't know how to manage money, that you're not that responsible, right? That can impact you moving forward. So they don't want to announce to the Fed that they're in trouble because the Fed's going to watch them like a hawk. Okay. So that's the idea here. So how we connect that with economic activity? There's expansionary policy, there's contractionary policy, or loose money and tight money. Okay, the idea is that by making more money available, the Federal Reserve is then adjusting the federal funds rate. Sorry about that, which then would alter the interest rates in the economy, right? So this idea that the Federal Reserve has some type of control over that interest rate. But let's see how that impacts economic activity. So this is going to go down to the loanable funds market. Okay, so we have demand for loanable funds, so borrowers, and we have the supply for loanable funds, so savers. Okay, so the idea here is that given a policy that's going to alter this market, which will lead to changes in the aggregate economy as well. Okay, so let's say there's an expansionary policy. So based on the three policies that we talked about so far, we know that would be the buying of bonds, right? The buying of bonds from commercial banks, which give them more reserves, right? Or the lowering of reserve requirements, or the lowering of the discount rate. Okay, if that's the case, banks would be able to provide more funds for loans, right? Because they will have more reserves and they have perception that the economy is doing better, right? And as opposed to do better, they're feeling more confident that the Federal Reserve is helping them, right? And if that's the case, you can see the interest rates are going to lower and there's more savings and investment in the economy, thus more loans are being given out, right? What about contractionary policy? Well, that's the reverse. Now it would be an increase in the reserve requirement ratio, it would be an increase in the discount rate, or the selling of bonds, treasury bonds to banks, right? If they're selling bonds to banks, and they're giving bonds to banks and taking away reserves, which means banks now have less funds to give out as loans. Surprise or not, that's exactly what happened. We see a decrease on the supply for this loanable funds market, right? That would cause the interest rate to increase and the amount of loans to decrease. Okay. So in general, how are the interest rates of the bank for the lending and borrowing markets determined? And this is why I wanted to bring this back. We keep saying that the Federal Reserve is changing interest rates, but I want to make sure that it's very clear that they do not have directly control over the federal funds rate. Okay, they do not have directly control over the interest rates. What they're doing is that they're changing the amount of money in the economy, which is then changing the interest rates. Okay, so they're implicitly altering the interest rate in the economy. Okay, so by what actually changes here is that because there's more money in the economy or less, depending on what type of policy they have, the forces of demand and supply change. Banks act differently, right? And if that's the case, then that's to the demand and supply interactions that the interest rates are changed, just like we just saw in the previous slides. Okay. So just summarizing, as you can see, the Fed indirectly impacts interest rates. They focus on the federal funds rate, which then tends to impact the other interest rates in the economy. Eddie, is that perfect? Is this happen with every interest rate as soon as this happened? No, that's one thing that it takes time to adjust, is that not all interest rates move together. And if one takes more time than the other, then that's going to cause the market in different, based on different loans to react differently. Okay, so those are all things that we have to consider. Okay, but more importantly here is that we're really trying to make sure that the Fed is setting the expectations about how much money is going to be available and the cost of borrowing money in an economy. Okay, so how to connect that with the aggregate demand? As you've seen before, is going to be through the changes in the consumption and investment, through changes in the interest rate. Okay, so the idea here is that if there's expansionary monetary policy, as we talked about, there's more money in the economy, which increase the amount of supply of loanable funds, which lower interest rates, right? Increase the amount of loans in the economy, which lead to more consumption and investment. Okay, since consumption and investment are part of the aggregate demand, which you know is equal to the GDP formula, consumption plus investment plus government spending plus net exports, right? If consumption and investment are increasing, we'd expect also the aggregate demand to increase. Okay, that's exactly what we see on the graph here. Okay, that will lead us to a higher price level and higher output as well. So something to consider here, right? They want to be able to increase output, but while controlling for the price level. And that's why they don't engage in extremely large expansionary monetary policies, because they're worried about inflation, as you can see here. Okay. What about tight money or contractionary monetary policy? Well, now it's the opposite, right? If we know now that the money supply is going to be decreased through one of those three tools that we talked about so far, that's going to lower the supply of loanable funds, which increase interest rates. And you can always feel free to go back a couple of minutes to watch that part of the video again. Okay. And that leads to lower consumption and lower investment, right? Which is going to lower the aggregate demand. Okay, and that's exactly what we see that. And we see that we can predict then that would lower to a that would lead to a contraction in terms of output, but it would also control inflation. So you can imagine that they could engage in contractionary policy during asset bubbles when the economy is overproducing, and also when inflation is really high. If they want to control inflation, contractionary policy, tight monetary policy is the best way. Okay, you can start, you see here that all this also, I'm also connecting here, is that this connects with something that we talked about in the past, that are changes in not only the price level in GDP, but also in unemployment. Okay, so you can go back and please, I recommend that you analyze how here the GDP gap was positive, right? We're overproducing. In other words, the unemployment rate was lower than the net rate of unemployment. Okay, and as we know that contractionary policy, and when that's the case, then resources are scarce because everybody's employed, and employers are bidding on wages, right? Which kicks the price of inputs up and starts increasing inflation. So a contractionary policy could then force the economy to contract a little bit, which would lower inflation and at the same time lower output levels. Okay, so you can kind of see the impacts of policy, right, on both unemployment and inflation here. Okay, here I'm gonna stop here, and I'm gonna continue the next video due to the time.